Okay, now it's time to start out the leases section of our long-term liabilities. And in this section, we're talking about operating and capital leases and the important distinction between them. So just getting started here, think about operating leases as relatively short-term, cancelable. The lessor, the owner, retains the risks and rewards of an asset. An example of these might be an apartment rental sort of thing, where we just pay our payment every month and we're good to go. But the landlord owns that, or the landlord or the lessor owns that particular apartment and gets to retain all the risks and rewards of the asset forever, sort of thing. You're just going to rent it from them. Capital leases are different. Capital leases are longer term, and just about all of the benefits and risks of the asset will accrue to the lessee, the person who's renting the particular asset. We see these sometimes in buildings, sometimes in equipment, that sort of thing. And there's some specific terms that we're going to go through with regard to capital leases and why we are concerned about those. Yes, they're recorded in very different ways. So an operating lease, again, think of this just like we're renting something for a month. It's recorded by the lessee, whoever uses this asset, as an expense for each payment. So in the first, the journal entry that you would record would be a debit to lease expense or rent expense for $1,000 and credit to cash for $1,000. Very straightforward. The lessee is just taking the asset and using it for a month. Still belongs to the lessor. Sometimes there's a security deposit required in this, which is set up as a prepaid asset. Again, just like an apartment lease, where you have to put down some sort of deposit, and hopefully you leave your apartment in good shape, and you'll get your security deposit back. Now, capital leases, a little more complicated, but they're recorded by the lessee as an asset and as a liability. So if it's a piece of equipment, for example, we record that equipment as an asset under a capital lease in the property, plant, and equipment portion of our balance sheet. And then we record the liability, and we call it capital lease liability on the liability section of the balance sheet. All of the benefits and the rewards of the asset are going to be enjoyed by the lessee. So it's basically going to be used up by the lessee, if you want to think about it that way. It can be another way of financing instead of using bank loans or mortgages or that sort of thing. Capital leases are another way of setting it up so that the user of the asset basically gets to enjoy the ownership of the asset and records it on their balance sheet. Now, for a capital lease, there's 3 different conditions that are available, and if you meet one of them, then the lease is called a capital lease, and we've got to record it that way in the bookkeeping and in our accounting. So the very first one I call the bargain purchase option, and it basically says that there's reasonable assurance that the lessee, the person who's renting this or leasing this particular piece of equipment or building, they're going to get ownership of this at the end of the lease. And one of those ways that usually happens is if we've got, say, a $1 purchase price at the end of the lease, so that the lessee can buy whatever it is for $1, and then the title for the particular asset will transfer to the lessee. Another condition that again makes this a capital lease is if the length of the lease will allow you to use up 75% of the life of the asset. So, for example, if this is an asset that'll last 10 years, generally that's the life of that particular asset, and our lease is for 8 years, well, then this is a capital lease, and we have to set it up with the capital asset being set up, or the property, plant, and equipment being set up, and the liability being set up. And there's another condition where, again, if the lessor or the original owner of the particular asset is going to get back the original cost of the asset plus a return in the investment, if the total cash flows are going to look like that, then again, this is a capital lease and we need to record it as that. And there are a couple of conditions that also must be met. They're less intrusive, but the credit risk with the lease has got to be normal. In other words, we can't have it where we're charging 15 or 20 or 25% in interest, because that's not reasonable in today's markets. Certainly something less than 10% usually is probably pretty reasonable. And the amount of unreimbursable costs is known. What that means is we know how much it's going to take to maintain whatever this is, whether it's oil changes in a truck or the maintenance on a house or an office building or something like that. We know what it's going to cost to keep it going, then that's fine. It's just if there was some crazy things that were going to happen somewhere down the road and you didn't know how much it was going to cost, well, then it might not be a capital lease. So let's have a look at a capital lease, and you're going to think about it a lot like a long-term debt. So I'm just going to pull up the amortization schedule that we've got for this one. So I created an amortization schedule for a capital lease, and what we are doing is we're buying a building for $1.6 million, and we issued the lease on we're not buying it, we're leasing it, sorry. We're leasing the building for and we're going to pay $100,000 as a down payment, and we're going to pay $130,775.94, not monthly but yearly. We're going to pay that yearly, and at the end of the term we're going to purchase this building for $1. So it meets the criteria for a capital lease. So what we do is we look at then what are the cash flows that we expect. The present value of the cash flows is $1.6 million, and we'll make a $100,000 payment right away on this thing. So here's the schedule that anticipates that. So January the 1st, 2021, $1.6 million is the present value of the cash flows. We're going to make a monthly, a blended payment, and not monthly, but a yearly or annual blended payment of $100,000. In this case, we're just going to make one payment of $100,000. That's the down payment. So that brings the balance down to $1.5 million. Then on January the 1st of 2022, which is a year down the road, we're going to make a payment of $130,775.94. Of that, $90,000 will be interest, and $40,775.94 will be principal. And so we will bring the principal on this lease, on this cap lease, down to $1,459,224. And you can see how annually we make a payment on the lease of $137.75.94, and we gradually pay down the principal over time until at the end of 20 years it's paid out. So that's kind of a cool way of looking at how the cash flow works on a capital lease. Let's see, I think the next thing we've got to look at here is the journal entries that go around this. So let's have a look. We'll call up the journal entries. The journal entries really are very similar to ones that we see for any sort of long-term debt. So for the building under a capital lease, we've got a debit here of $1.6 million. So we set up the building, and we use that, the caption, building under capital lease, so that we identify that it's not just a building that we purchased, but instead it's a building that we've leased, and we call it a capital lease because it meets the criteria. Then we paid out $100,000 in cash, so there's the credit side. And then we set up the capital lease liability for the $1.5 million that we're going to pay over time. Then what we do is we look at the asset, and you can see now we've moved almost a full year ahead. December the 31st of 2021, so 364 days later, we're going to record the amortization on the building. So, for example, if this asset lasted 20 years, okay, we'd say we could do it over the term of the life of this, or if it was 25 years, which I said in this case, even though the term of the lease is 20 years, we're going to do it over 25 years, which is the expected useful life of the asset. So we're going to record the amortization expense for $64,000 and credit accumulated amortization building under capital lease. So similar sort of naming convention to what we normally see for accumulated amortization, plus the building and this little under capital lease, so that we're able to identify that this is part of the capital lease asset. One of the other things we've got to do is, because we're almost a year into this capital lease, we need to accrue the interest liability. So the interest that would accrue on this is $90,000, and you can get that number right here from the amortization schedule. If you look here, one day later, so on January the 1st of 2022, we're going to make a payment and we're going to pay $90,000 in interest. So we should accrue the $90,000, so we match up that interest with the term of the that we own the asset. So or the term that we've had the liability. So we've had the liability for a year, so we should be recording 1 year's worth of interest, and that's what that does. And we're crediting not interest payable, but instead we're just setting it up under the capital lease liability and increasing the capital lease liability by the amount of the interest. And then finally, the next day we actually make our payment on it. We pay $130,775.94, and we pay that in cash. So we charge it against the capital lease liability, and you can see we actually have the interest already charged in this entry right here. We pay down the capital lease liability and we pay out the cash. So down goes the cash by $130,000. So it looks a lot like a mortgage or a long-term loan with that sort of thing. So keep that in mind as you're going through these journal entries. Now back to our PowerPoint presentation just for a sec. I want to talk about the balance sheet presentation for a capital lease. Again, it's a little bit different, not crazy different, but just a little bit different. So for the balance sheet under current liabilities, instead of having current portion of long-term debt, we'll have current portion of capital lease, and that would be $137.76. I've seen this also be called capital lease liability. Either way, it doesn't matter, where we just have to disclose that it belongs to a capital lease liability, and it's the portion that we're going to pay in the next 12 months. So that's that $137.76, which is really the interest and principal in this case on the capital lease. Then the longer term portion, or the portion we're going to pay sometime after that, that's the $1,459,224. That amount is right there, and that's the amount that remains after we make the January 1st, 22 payment. We still owe $1,459, or $1,459,224. So just know that you have both parts there that you need to disclose and set up on the balance sheet, one under current liabilities, one under long-term liabilities. But in this case, the total of those two is actually the total loan plus the interest that's payable as well. Okay, I hope you learned a little bit about capital leases there. Take a shot at some questions. And yeah, I'm sure you're going to see this in your working life for sure.